Hey everyone, we are back with another episode of your Advanced Engulfing Series. Today we're gonna be discussing an alternative way of looking into your market direction and storyline. Very important video, especially those who trade currency pairs, since a lot of you guys DM me that I'm not really able to get clarity with the engulfing concept while trading the forex pair. So here I'm today gonna be explaining you how you could, build a bias and get a picture clarity of what is happening on the market. Okay, so before we begin, I want you to watch this video till end, and this is going to be a raw format since I don't really have planned for it. So bear with me and watch it, right? So first we're gonna be discussing the very basics of market. Like every market has different phase which they are going through, which we have been explained in the Dow theory. I'm pretty sure you all are aware of the principles of it. So I'm gonna just explain you the very basic. In a bull run phase, there is gonna be an accumulation phase where the smart money will accumulate for the buy orders, right? And once we break out of that range, there is gonna be a markup phase, or you could say a trendy impulsive move to the upper side, right? So after the accumulation in markup phase, there can be a reaccumulation phase, which we can also call as a rally and a base and a rally, right? So that is another way to enter into the market for another, long run, and it could have another as well. So, but what will happen is price can just keep going higher. A trend will has to exhaust. So when exhaustion comes into the market, while if we are dealing with the bull run, there is gonna be a distribution phase, right? And then after breaking out of the lows, we will have a markdown phase, and the vice versa goes for the bearish trend. So basically what I'm trying to tell you is we just have to understand which phase we are currently at in the market, so we could trade with the trend, since what we have been taught as trend is your friend, right? So the most money that you will ever make is following a trend, catching those impulsive moves with the higher time frame trend. So, and there is another concept which I guess you guys have heard about as auction market theory. It purely relies on the volume, but I'm gonna try to relate it with the basic, market, understanding. So we have auction market theory, which basically relies purely on the volume. But since I'm a CFD trader, so volume is not relevant to me. But for the future, guys, make sure you should look at this theory. Very, very beautiful theory, will explain you how really the market works. But just to give you an idea, what auction market theory says is, let's say we have this order flow or volume nodes over here where the most trading action has been done. So it is a fair value. This trading range is what they call as fair value. So if price is in the fair value, so these volume nodes or the order flow will have a value area high, a value area low, and then there is going to be point of control where the most orders has been executed. So, and then this is mid value, fair value area, fair value area, and these are the upper and lower channels. So what happens is, once price in the fair value, it will look for a discovery. So that means price will look for a trending phase. So once we break out of a fair value range, price will go into the discovery phase, and then there are two possibilities. Either price will come back to the previous fair value area and go for another discovery, price in discovery, or either it could build a new ranging market or a fair value over here. So this is similar to what we just discussed over here, or it could make a new fair value area and then look for another discovery in price, or price will do the discovery. So what, how does it relates to the basic phases of market? You could simply see that accumulation phase is what we can call as a fair value, or a distribution phase. It can be also called as a fair value, and there is going to be markdown and markup phases, right? But this theory gets very in detailed with the volume, and there is a lot of components that need to be looked at. So I'm not really gonna go into that, but just to explain you that once we are in a range of fair, price will always look for the trendy phase, or a price will go into the discovery, right? So our our duty is to understand which phase we currently at and trade with according to that to look for the trending phase to either to the downside or either to the upside. So just to give you an example of this auction market theory on the IC market broker, which is CFD. So the volume is going to be irrelevant, but just to show you an example, we have this range over here where a lot of trading action has been done, right? And then we have a value area high, POC, and value area no. So once price broke out of this range, price goes for the discovery, right? And now there are two scenarios that can happen. One is that price will make another your ranging market, fair value area, and then do the price will go for the discovery or impulsive move to the upper side, or either it could be to the downside will happen. But in this case, what happened, price came back to the previous fair value range and then again looked for the discovery. So looking at the previous structure, we can clearly see price was really bullish. So coming back to the range again, there is a possibility it will look for the discovery again. So this is what we gonna be learning today with more rules and just based off price, not the volume. So if I just mark this value area low, look how precisely it reacted and then give you the impulsive move to the higher side. So coming back to the topic, so if we are not gonna be using volume, then all we are left with is price. So for the price, we will be using your market structure to understand which phase we currently at and trade with the higher time frame trend and understand are we in a continuation phase or in a pullback phase. So the video is gonna get a bit longer, so I want you to watch this till end, since there is gonna be a lot of good concepts that will be taught, right? So a very basic thing about market basically has your three trends. One is gonna be your bullish trend, right, when price will be making higher lows and higher highs, right? And then there is a bearish trend as well, where price will make lower lows and lower highs. And then we have a ranging market, right, a sideway market. So we have to understand which phase we currently at by just looking at the market structure, right? And then also understand, are we in a continuation leg, are we in a pullback leg? These information will help you out to understand which phase we are currently at, right? Okay, now going a bit deeper into your pullback and continuation legs, what key components are there in a swing structure? When I say swing structure, I mean a impulsive move to the higher time frame trend, breaking out external lows or highs. So a swing will have a swing will take external liquidity. When I say I am not really gonna go deeper into your liquidity parts, but just for the sake of example, we have to learn that as well. Okay, so when price breaks out an external lower low, this low over here is a weak low. Why is that a weak low? I hope you guys know about what are weak lows and strong lows, and what are weak highs and strong highs, right? So over here, this lower low didn't broke anything important to the left. So this is a weak low, right? That will be targeted later when we will have the continuation, taking out this external liquidity. That is what here we meant by taking out external liquidity. And then swings are basically the ones that forms extremes. So this lower high to this lower low is what we call as our extreme points, right? From this range, point A to point B is our extremes, right? And swings basically result in breaking a structure. So we over here see the lower low has been broken by a swing leg. So that is why we say they result in break of structure. And then we swings basically follow your higher time frame trend. So in this case, your higher time frame trend is pretty very easily we can see this is bearish, right? So these swing structure to the bearish side is following the higher time frame, correct? And then what are pullbacks, right? Let's understand that. So pullbacks basically is a way to manufacture your liquidity. So this is a corrective move to the higher side, is what we call as corrective pullback, right? And what is happening, price is building on liquidity. It can be in multiple ways. One could be a buy trend line, or it could be equal lows, and there are a few more other ways how liquidity will be formed up. So pullbacks usually create the liquidity that will be hunt later when we have the continuation, and they are basically counter trend to the hard time frame, and the hard time frame was to the bearish, so it is a counter to that, to the bullish. Allow for better pricing and mitigation. So when I say what we mean by that is, so price can't just keep going lower and lower. It has to come into a fair pricing. In when we compare that, we can say price has to come into a premium range, so that we could get at a better price to look for the sells again, right? So pullbacks are mm, formed for that reason. And then we have mitigation simply means there is going to be unmitigated supply areas that will be mitigated once we have the pullback back to the swing structure. So this is the key difference between a swing and a pullback. By the way, shout out to the guy for this markup. These are not really mine, but I will try to explain you from these drawings only. Okay, so and then we have your multi-time frame analysis. So a swing structure on the high time frame, we know that is the trending move, but or pro trend, correct? But a corrective move can have their own pro trend as well. When I say that, since price is fractal, let's say this is a weekly bearish leg, right? And this upper move to the corrective move on the H4 will itself be a pro trend, right? So it just depends which time frame you are looking at. If each time frame will have their own pro and corrective legs, right? So over here, if you look at, this is H4 bearish trend, right? And inside that we have M15 minor structure, right? So over here, if we just look at this example over here, this corrective move can have their own pro trend to the higher side. Just give me a second. All right, so since price is fractal, every time frame can have their pro and counter trends. So you just have to understand which time frame you're looking at, and on the what's happening on the lower time frame, right? We will go into this in detail in the later part. Just to give you a basic idea, we just understood the basics of market structure, correct? Now we have something called ranges. Very important concept. They are very similar to what we can say market structure, but the difference is that we simply mark your sell to buy movement, or buy to sell movement. So basically ranges are a great area from where we can look for this buy and sell opportunities. So, and if a new range has to form, it will take a lot of capital, right, to form a new range. And once we price comes back to it, there is, you can look for the opportunities to buy and sell there, right? Since they are just simply your reaccumulations and redistribution phases. We just discussed on the basic principles of your Dow theory, right? So during the pullback phase, let's say the trend is to the bearish side. If I just open this up, yeah, so over here, if I look, let's say example, the trend is to the bearish side, so this is now a pullback phase. So price is making what sell to buy movement, or sell to buy range. So this is buy range, buy side range, right? So this is a corrective move to the upper side, but the overall trend is to the bearish side. So once we will hit something from the left of solid supply area, and price does what? Price fails to break the high. That is one confirmation. One time, there are two types of reversals. One is when price fails to break an high, or one is when price may break something strong, right? So when I say strong, in this bearish case, it broke a strong low that resulted in a higher high. So when we break that, that is a second way. Price is a second type of price reversal, and the first one is when price fails to continue to go higher, or fails to continue to go lower, right? I'm gonna discuss this in a better format in later video. Just to tell you the back to the topic is that we in a pullback phase is making a buy range, but when we have a reversal, all these buy range will now be targeted as a liquidity. So these all will be taken out. So while we were in a pullback phase, this can be a pro trend in M15. Let's say this is, let's say, H4. So it could be a pro trend, but once we had the reversal, these all will act now as a liquidity point. They were a very nice area to look for longs for the M15 structure, but now that there is a shift, these all will be targeted as your liquidity. Very simple, right? You can read this out if you have to, right? Very simple, correct? If I just show you the example in live market, how you could have your ranges, how you can mark out your ranges. Just to look at on this structure over here, we can see we have this whole buy to sell range over here. Sorry, sell to buy range. So this is another, and now we had a sell range right over here, and then we had another sell range. Okay, very important thing, every range needs to have closing below the low or high. Very important thing, since wicks can just be sweep and acting as a fuel for price to go higher or lower, right? So we can even mark out the minor ranges. Will in this case this is wick, but on the M15 might have close, since this range over here is not really the H1 range, it is more of M15 or M30 ranges that are marking. So just for the sake of example, these are your sell range happening, and once we had the shift over here, this is your now buy range, correct? So what happened, we would be expecting this strong high to hold the price and target for this week low, right? But what happened was this minor range, this buy range, price was price holded to that range and eventually pushed price higher. So this is where the range concept comes in handy, where you will be able to understand what are your odd blocks that could alter your direction. If I just look at this range, this is simply the same thing we mark as engulfing. If I just go to the H4, let me see if we have engulfing buy or sell. So you can clearly see this range over here are marked. You can either be marked as this EG buy. So that was your odd block, and price was failed to break that, even though this was a weak low, since it never broke anything to the high side. So this weak low was what we were targeting. But what happened, price failed to break this recent buy range, right? And what happened, price reacted and eventually broke these all highs. So now what happened, again price did what, price made a new range. Ranges can you will have multiple ways to mark out your range. You will have major ranges and minor ranges inside that. For example, this is a major range, and this can be considered as your minor range as a pullback phase, right? And we continue to make those range. And can I consider this as the sell range? No, because price has just wicked below this, so it can be just a liquidity sweep over here. Very beautiful example, to be honest. So this low can be just a liquidity sweep to fuel the price. Liquidity act as a fuel for price to continue the trend again. So this was a major range, buy range. Inside that we have something on the left. Let's say this is the demand that we are looking at. Price came in, like swept that low, and that acted as what, as fuel for price to go higher. And then what happened, price was now making what, buy ranges, right? So this is your buy range. If I just show you in the H1, yeah, this is your range, buy range. This is your another buy range. Price came in, reacted, then you have what, another buy range over here. And then what happened, price makes up another buy range over here. We can just mark this out. This is another buy range, and price was continue to hold the lows and continue to build bullish ranges, right? This is your another range. And now what happened, price came into this major buy range. Inside, while pushing back to the range, there was another sell range. Price came, reacted, but what happened, it failed to break that sell range, and that what made another sell range, and eventually price broke these lows and even this area over here. So this is how ranges can come in handy. And if we just compare this with engulfing, it is simply the same thing that we are doing. Okay. But I want you to stick to one thing only, either your market structure way or the engulfing way, because the lows and highs can be a bit different, even though the concepts are very similar to each other. But since, let's say this example over here, let me see some good example to really show you. So um, over here, let's see this area over here that we have marked. So this is the whole buy to sell range, but for engulfing trader, this break may shift the storyline. But for a market structural, a trader who is using the market structure, swing highs to swing lows, will only have the structural change when we break this low. So even though the concept both are very similar, but I want you to stick to one, okay, so that you don't get confused with the conflicts, right? Very easy concept, and it can be very helpful if you are trading the currency pairs, right? Coming back to the topic, so over here, what are weak lows and weak highs? Just to let understand why what happens on the price when shift in structure, shift in price comes in, right? So let's understand that. The very first type is your win price fail to break expected level. So if price is bullish and if it fails to break this high over here, this is the recent leg or this is the recent high, price comes in back to the buy range, but it did what? It failed to break your previous high. So that is one, that is giving you a weakness or telling you a signal that price is now not um, ready to go higher, and eventually it can break out of these lows. That is what first type. And for the sell also, price was continue to make lows, but what happened? It failed to break the previous low and eventually broke your external high. That is another shift in structure. Just to clarify, it is better to have two lows taken out. So this is your, if let's say price is in a bullish structure and price takes out this low over here, external low, can we say there is a shift in market structure? I would say you should not. You should wait for two lows to be taken out. Why? Because this first break could just be a liquidity sweep, a fuel for price to continue to go higher. Okay, so better to have two structural breaks and then look for the opportunities. Okay, and then again, should we just simply ignore this break over here? No, you can simply look for the supply, and then look for lower time frame to align. If it aligns, then you can target for this low, right? But the real structural change happens when we break two lows. Okay, very simple. And then there is another type when a structural change happens. The one is when we break something, let's see, when we break some protected levels, right? When I say protected level, this means strong lows or strong highs. So this was a strong low. Why? It broke previous high, so it is a low that should be protected if price has to continue to go higher. But what happened? Price broke it. That means what? That means there is a shift in structure. Correct? Easy thing, very easy. You can read this out if you have to. The video will get very longer if I try to explain you everything. I can make a few more parts if you are guys interested in it, right? But today the major topic is to really understand which phase we currently at, how you could look for the opportunities to trade with the trend, or should or also understand how you could also trade the counter trends as well, right? um so over here I have a beautiful example of a bearish trend over here. Let's say this is a bearish trend. So let's say this is a weekly bearish trend, and this is a corrective move to the upside, coming back to some weekly supply range, a strong supply range over here. So this H4 structure in itself is a pro trend, right? So can we look for buys even though we are bearish on the weekly time frame? Yes, you can. Why? Because in order for price to change the structure or do the continuation, it has to break out these lows, these strong lows. It can't just simply, um, turn bearish. It has to give you the signals that, okay, I'm ready for in a shift in structure. So all these buys, you can hold out until you see the shift, right? So this is a pro trend in itself, right? And what I just mentioned you guys, that when we are in a corrective phase, all these buy range will act as a liquidity on the later phase in the future, when we will have the continuation, right? So what happened over here at the recent strong, this low over here that held price and came into something important to the left. Price came in, okay, something for the SNR traders who understand this concept. We will try to relate that as well over here. So there is a concept called breakout cycle, right? It consists of three things, which is breakout, VR, which is valid retracement, and then there is CF, which is confirmation. You will see how beautiful it relates to your market structure. So breakout is your high time frame trend. Let's say this is H4 breakout. So that is your trend or your direction, that is buy. A valid retracement means when a lower time frame shift happens. So H1, let's say, have VR, okay? So that confirms your H4 price cycle, and price comes back into the range, and that is the confirmation again for the H1. So it is simply the same thing that we do in market structure. Why? Because we have a impulsive move to the upper side, right? This is the swing leg, correct? That broke a high, and then this is the pullback leg, and then we will have another impulsive move to the upside. So we are simply following the same cycle that we have been taught in the SNR way, very similar. And if I just compare it with this area, um, so what we have is, let's say this was H4 cycle, right? H4 buy range, and this is what, let's say, internal structural break. So that, let's say, this is H1 VR. Price comes in, does the confirmation, goes higher, but does what? Price fails to break the VR, and eventually breaking your strong low. Very important thing, okay? Focus on it. So we had H4 break to the upside. What happened? There was an internal break to the lower side that confirmed the VR or pullback phase, and price did some reaction to the buy higher side, but fails to break the VR, and did what? Eventually broke the strong low. So there is a shift in structure, and I just mentioned you that all the corrective buy ranges will now act as, your um, liquidity that will be hunt in the later part, right? So what happens? Let's say price, while pushing higher, price was making equal lows on trend line liquidity. Now that all will be hunted till the point we break the external low, right? Because that is now weak low that will be targeted. So this continuation phase we just understood, and this pullback phase as well, and it will continue to do all that. Over here, this is interesting part. So we were in a bearish trend, right? We have supply zones are to be looked at. So what happened over here is price reacted to a supply, did what? Did a break, right? Can we consider this as a market structural shift? No, you can't do that. Why? Because this low never broke anything to the left. So this is not really a strong low. This is simply an internal break, and can be used as a liquidity, a price, fuel for price to go higher back into your mid range, and into your origin, maybe deeper into your supply zones before pushing lower. So always be aware of what that low can be used as, okay? Very important. How to protect yourself from these cases? Just look for strong lows to be taken out, right? And also, when we push back into your supply, let's say point of interest, wait for lower time frame to align again. So let's say this is the strong low, right? Price breaks it. Can we say there is a shift in market? Yes, but to be more confirmed, you should wait for your supply zones to give you another sort of, change in order flow to the bearish side to look for the sells. order flow shift is very, very important. Not just the structural lows has to be taken out in case of Barish, the order flow shift is also very important in lower time frame. When we will talk about the entries part, you will understand how order flow shifts. Okay, and then we have this example over here. I'm not gonna go into that, but just to, I just want you to guys to see this. The same thing which we just discussed over here is happening in this chart over here. Okay, you can read this all out. And yeah, so we are in a bearish trend, and this all corrective move, the strong lows will be now be targeted as a liquidity point when we are in a continuation phase to the bearish side. So these will be targeted, right? And then we will eventually break the low, external low, and then we will again look for a continuation phase back to 50% of the range, or maybe something that was responsible for the break. If I just look at this example over here, what was responsible, which base or the sell range was responsible for the break? So over here, if I look, this was the demand, right? This was the buy range that held price. So if I just plot this out, we can see this leg over here, major leg, was responsible for the break. So this is an area to be looked at, this whole range. In this example, we just marked the very extreme, but in reality, this is the whole range that from where price can react from. Okay, so what happens, price comes in correction phase, it was making higher highs. The trend, pro trend in lower time frame was to the bullish side, and it was making liquidity as well along the way, right? What happened, price reacted to the demand, came in but fails to break this area. So this is your first type where price unable to break and unable to continue to go higher, and then what will happen, eventually it will break and continue to go low. We are very first type of market reversal, right? What happened, price failed to break something over here, goes lower, there is shift, now it will continue to go lower. We are back to this lows, these lows will be targeted, these external low will be targeted, right? So by just plotting out these highs and lows, you will understand which phase we are currently at, and should we take an entry or not, correct? And when you are in a corrective phase, there is not a much um, I would say range available for you to buy. Better wait for continuation phase to happen and then look for the sells again. For this example I'm talking about, right? For the sell example, I have so much to go actually, but just to make the video short, since this is not really the concept I had in my mind to explain you guys, I was gonna majorly focus on engulfing. But for the traders who trade currency pairs, this was a necessary video. There is a lot goes in detail with the very minor details, but for now I will go to the very basic overview, and I hope you guys all understand, right? So, and then we have how could we precise our point of interest. So over here, this is a way to precise your point of interest. So when we have a major structural shift, you have to look at a region from where the actual shift came in the lower time frame. In this example, this minor higher, this was the strong low that was broken. So this was what the origin of move, and price came back and mitigated it. So now the second fresh supply will be act as point of interest, and point price will come back. We will definitely have some reaction to it. Again, what happened? We make a new lower low, price push in. What happened? This was the origin. This from sell, buy to sell, broke this low and as well as this low. So now that will be used as our point of interest in future. And why specifically we mark this hidden base? The reason for that is this base was actually responsible for breaking out of this low. This was the base that broke this low, as well as eventually we had the break of this thing. So from here we had the origin from where the sell really kicked in, right? So we will have a reaction to that, right? And then again we have a break, minor break. So what was the origin point? We can clearly see this was the leg, and this was the cell that initiated it. So if we come back, we will definitely have a reaction to it. It just keeps going in that way. So that is the way you could, refine your point of interest, and you can read this out, um, very easy. So now let's see. Okay, so maybe let me see. Yeah, so this is an example of your, order flow in, order flow shift in lower time frame. A beautiful example of, entries part. Let's say, um, I'm really sorry if I'm skipping a lot in this video. This was not really the video that I was expecting to make, but just for the currency traders, I'm making it. So this is, let's say price has reacted something from higher time frame over here, right? So price comes in, does what? Breaks out this low over here. This was an external, sorry, high, strong high that was broken. And very important thing, how it broke it, there was this V-shaped recovery. V-shaped recovery usually tells you that there is now a very beautiful shift. Buys are taking in control. Buyers are taking in control and broke this high with a V-shaped recovery, correct? So once we had this structural break, this is the whole continuation leg. Price did what? Price came back to the zone again. It did what? It made a V-shaped recovery, and this was the recent buy leg, right? And this was the recent sell leg, or sell range. Price broke it. That gives you two structural breaks now. So once we have two structural breaks, we can, consider this as a market structural shift, right? So what happens? Price comes in, makes minor, buy um, ranges. That is telling you what. And again, very important thing, if you just look at base of engulfing concept, this was the sell range or the EG sell that pushed price into the zone. What happens? Price comes in. What happens inside the, while we were pushing into the sell range, the CMP was telling you to buy. Why? Because the order flow was to the buy side. So entries taken here is very, very, um, low risk, because the overflow, or sorry, the order flow is shifting to the buy side, and there is enough um, enough confirmations that was given to us, right? Am I telling you to use M1, M5, your or second time frame? No, you can use the same exact thing on your M15, M30, and even your higher time frame. Um, in right. So in the, this was basically from a SMC viewpoint, where we usually use the very lower time frame, but this can easily be um, used as higher time frame context. Same thing, price is fractal. Price will do the same thing in every time frame. So you just have to understand the concept. That is very necessary. Other than that, everything, price is fractal, and it will keep doing the same thing on each and every time frame, correct? So um, just to show you, and a live example how you will mark out your zones. So this is a monthly zone, a monthly time frame of, I guess, Euro USD. So what happens is price takes out this monthly low and this minor structure as well. So this was the move. And over here, if we look at this range over here, if I just look at this over here, demand over here, this was swept, this high low was swept by this range, right? Broke something, and this was the origin demand that held price for quite a long time, correct? And then what happened was, this was the buy to sell movement that eventually broke it. So this flip zone over here becomes very important for us to monitor, correct? So that is one way to refine zones, correct? And then what happens on the weekly, let's see that. So while coming back, weekly was clearly bearish trend, correct? So, and then what happens was, while pushing back to that monthly supply area, um, we shifted bullish in the weekly time frame. It was just a one structural break, so it can just be a liquidity sweep for price to fuel and go lower, correct? So on the weekly time frame, we do have a market structural break, but we can't really say there is a shift right now, right? So over by looking at the major structural way, we are still bearish, and this is the recent EG sell or order block, anything you want to call it, to be monitored, to sell back from here to this zone. from point A, from sell zone to the buy zone. Why this buy zone? Because this EG buy was responsible for this break and taking out this high as well, from where the origin, buy move kicked in, right? Or or if we just go a bit detailed, I wanted to go very in detailed about this concept because it is a very beautiful concept. But if you want me to make videos, then let me know. So over here, what happened was this support held it, and this was the recent buy leg. What happened? Price pushed back a high, broke it by the wick, and then came in. So everything over here has been mitigated. So now the one that eventually broke this high and even by the wick this. So this was the fresh demand we were left with. So any sales taken over here will be taken back to this zone. Okay. Same thing over here. This leg was mitigated. This was not really mitigated. So either it could be this zone or can come back to this zone before pushing lower, right? So this is what weekly was telling us. This is how you will be able to understand which zones can be your point of interest and what is your next target, right? Monthly, weekly, we just understood we are bearish, right? And then on the daily is quite bullish, and daily has structural shift to the upper side, to the bullish side. But we understand we also in our weekly supply range, right? And we have few refinement. You can see how we have refined the zones, and we can look for the reactions over there back to where. So our first target in the daily time frame is back to this zone. Why? Let's understand that. So over here, um so this over here was broken, leg was broken, this was broken, this was broken, and eventually we had the external high that was strong high because it was responsible for this break, was taken out by which leg? This was the EG buy that broke it. So any sales taken is gonna be your target is initially going to be this one, right? And this is a very valid flip zone. Why? Because this supply zone was taken out by this leg, and it also swept this low. So when we have, okay, let me explain you. So let's say we have a supply zone. What is a valid supply zone in terms of SMC? Let's understand that. So we have a supply zone and price comes in, and let's say this over here, this buy zone or the buy range was responsible for this break, right? That is one point. But the second point is that it has taken out this low before breaking out. So in this case, this low was, taken out before we broke this low. So that makes it more stronger and valid. So when price comes in, there is for sure gonna be reaction, and we are not sure if it's gonna continue to go higher, but there is gonna be reaction for sure. That what I have experienced in my past journey when I used to trade this concept, right? So daily is bullish, weekly and monthly is bearish. So on the H4, what we can do is precise our zones again, and you can just simply look how did we do that. And again on the H4, the current structure is very bullish. So order flow is very bullish, but we have to understand what understand that cells can come any moment because we have monthly and weekly supply zones, and the ones that were responsible for the break. And over here, even though the H4 is very bullish, but we have made a one time frame confirmation, right? If we just compare with the engulfing concept, or if you just look at the price cycle, this is the breakout, and this one time frame confirmation is your VR. And price, even though it does react from there, there is possibility it may fail to break the VR, and it can ultimately break our strong low, and there is a shift in market, and then it can eventually push back to the daily. So it just the concepts both are very similar, but I want you to stick to one because the lows and highs can be a bit different. Okay, so now buying makes sense, but also understand this is the leg that this is the resistance that can hold price for the lower area. So this roadblocks is very important to be looked at. Okay, And on the M15, now the liquidity part kicks in. So H4 is bullish, M15 was making buy ranges, bullish range, right? Eventually we broke it. So internally M15 is now bearish, right? We had this liquidity, buy side liquidity that was taken. Um we came into the very origin of this demand zone, made a V-shaped recovery, right? And if we break out of this external low that was responsible for this low break, we could expect market to go higher back to this range. This is how you build context. Okay, so I have skipped a lot, I understand, but if you want more videos in detailed about this concept, I can make. But I guess we have understood the very basic how you could use this as a market, how you could use this concept to understand the market direction and storyline, right? Just to show you, okay, for the entries, I just mentioned you before that not just the point of interest or the structural shift is important, but the order flow in lower time frame is as much as important. For example, over here, let's say this was the demand that was created, and let's say the overall structure was to the bullish side. So when price comes into your point of interest, make sure that there is a shift in order flow, price holding out your lows, and that's when you should be looking for the buys, especially if you are trading lower time frame, so that you don't get into your liquidity traps and sweeps. Okay, so order flow shift is very, very important. This is a cheat sheet to your entries. You can read this out. This is very basic thing. So pause this video and you can read this out. So over here, this is a beautiful cheat sheet to really understand the multi time frame, how you can enter into the market. So let's say you have an H4 structural to the bearish side, so bearish, right? So M15, let's say, is currently to the bullish side, so this is a leg that you will be looking for, right? So if M15 is bullish, you want the M15 to shift to the bearish side. So this is what happens when we came into this zone, kicks in, there is a shift. I want body closer, a solid closer. Then we can plot our range, and this is the premium area from where we can expect market to do the reaction. And then what, and then you can use the M1 order flow, and then M1 shifts. In this, when you are using M1, you should always wait for it, at least two structures to be taken out, and then look for the opportunity for the your entries, right? What will be your first target? Your first target is going to be the next M15 low. Why is that? Even though if price takes it out, there is always a possibility that it can come back to the range again and then do the another continuation. So always take out your partials when a low or a high has been taken out, external low and high has been taken out, right? So you can even go to the second time frames, but I know not really recommend. Do you have to use this on the M1 and M5? No, you can apply this on the high time frame as well as in the mid time frames, like M15, M30, each one. Since price is fractal, it will continue to do the same in every time frame. Okay, so this was one trade example where we are following a pro trend, right? How could we use this on in the counter trend? Very simple. The, let's say, H4 structure is to the bearish side, right? So the trending move is to the bearish side. So M15, while pushing back to the zone, will have their own pro trend to the higher side. So let's say price broke something over here, this high, and now this is the leg you are expecting market to react from and go back to your supply area. So how would you use that? In this case, when you are walking with your counter trends, make sure you always look for few more solid confirmations. So let's say this is the M15 zones that you are dealing with. Price comes into your discount area, and then what happens? M15 changes structure and another structure shift happens. There is a lows that are being held, giving you an idea that there is a order flow shift. This is where you should be looking for the buys, targeting the next high M15 and later your very next H4 supply zone. Okay, if you want more videos on it, like actually going into the live market, then do let me know in the comments. Okay, so this is how we will use the entries part with the direction in this concept. Okay, not very similar to engulfing, but I use a but different way of entries in the engulfing, but we will go through that as well in the upcoming videos. um so yeah, this is all for today, and we have discussed a lot. So this is how you could trade the currency pairs by the help of market structure to understand which phase we currently at. Are we trading the um, continuation phase? Are we in a corrective phase? What are the nearest rod blocks? What are the targets? Where should I book for the partials? So, and what are the confirmations that are needed? So combining all this together will give you a really good clarity what is happening on the charts. So this is all for today. I know this video was, you know, not something much practical in and showing you in the live charts, but if you want that as well, I can make a video as well. So, but yeah, that is all for today. Have a great day, guys.